If you haven't seen my risk management video, I did a video, I guess it's already almost a couple of years ago. It's just as good today as it was the day I made it. I'm considering doing a follow-up sequel to it. But a lot of those lessons are lessons that I've learned. I've been trading really since I was a kid. For 20 years, I've been trading stocks. I kind of got started right in my senior year in high school, although I had been following stocks for years. My grandfather used to buy me stocks when I was a kid, and I used to remember looking up the tickers in the Wall Street Journal back before online was before there really was even an internet. So that's kind of my background. That's really how I got started with this. But yeah, so that video really discusses a lot of my knowledge and some of the mistakes that I've made in the past as a trader, and in many instances, some hard lessons I've learned. If you're struggling and new in the trading business, I highly suggest taking a little time and watching that video. It will, I believe, help you immensely. It's sort of like the cliff notes to what not to do. I actually pulled it up, and I was thinking about some of the mistakes that I remember I was discussing that I'm seeing people make. And let's start out with what's going on in the market first. I want to give some context. A lot of people don't seem to understand the game. I often talk about, if you know the game the market is playing, you're about halfway there. And I think hold on. Oh yeah, one more thing. If you happen to catch this video late, or you want to watch it again, it'll be on my YouTube channel, which is at Justin Pulitzer Trades. I highly suggest subscribing there. You'll get you'll get notifications when I post new videos, which is nice. So let's talk about what's happening in the market and what I'm noticing on the stream and what I'm hearing in the media, and just the feel that I have taken for the market. So, okay, so there was a potential Head and Shoulders top setup a couple of weeks ago, and I had talked about that I wasn't kind of on that bandwagon, that I was still in the all-time high camp. And I was berated a bit. I had a few people tell me I'm an idiot and some other adjectives. You know, can I see the technicals? I always love being schooled on technicals by, basically everyone who has a trading platform these days and has a chart thinks they're a technician. They tend to not look deep into the technicals, though. They watch TV and they see, everyone is talking about a head and shoulders pattern, and of course it has to play out that way, right? The answer is no. I basically had talked about us, and I don't want to get too quantitative here. I want to be more qualitative because you can't see the charts. I get a lot of complaints from people that, oh, I can't see the charts. It's hard for me to follow along. So I'm just going to keep it really simple here. We had a very sharp snap, the regular rebound, a move lower, and then another rebound up. What changed things for me was the Fed. Yellen got very dovish. She talked about risks being dovish again. They had gone from being dovish to starting to sound hawkish with that BS rate hike they did in December. And then she basically said, I'm sorry, I didn't mean it, just I'll never do it again kind of talk. And that was my take on it. And that changed me from thinking we're just going to get a responsive move back up to that we're probably going to now see all-time highs again. There are three components that I look at when I look at the markets. You can break them down a little bit further, but I'm keeping it general. I've heard people break these into 5. I keep it simple at 3. All right, so I look at the stock-specific risk, meaning is the stock in an uptrend, a downtrend, are the fundamentals for the stock doing better or worsening? The second one is the overall trend of the market, the tape. Are we in a up tape? Are we in a down tape? Are we in a sideways tape? That's the context. And the third and maybe one of the most important ones, and one that kind of takes, I guess, a little bit of seasoning to understand, is the macro. And when I talk about macro, I think most people think about, is there terror, or is there some type of geopolitical risk? Yes, that's a component, but the more macro that has taken hold here is Anybody? Anybody? The Fed. So the problem for most bears are, and what has been for the last few years, is that to get a crash, a real move down in the market, and I'm not talking about 5 or 10% correction. I'm talking about like 2008 and 2009, or even 2000 and 2001. That was a pretty vicious downturn. You really need credit problems. You need to see credit contracting, and that is what, when money is cut off, the sort of the oxygen to financial markets, that is when the you-know-what hits the fan. We don't have a credit crisis at the moment. We started to see an uptick in credit. We started to have some problems, and that has since alleviated quite a bit. The downturn before Yellen was starting to look that way, and she sort of took the pressure off. That's really the ingredients you need for a super-duper big move down. I've been getting, so this is what I was teasing at. A lot of people keep messaging me and asking me when it's going to be time to short the market, and is this a top? Are we near the top? Is it over yet? That is not euphoria. When you get a euphoric, and it's amazing. I did a post a few weeks, maybe a week or so ago, and I asked, are we in a euphoric tape? And I was shocked that, I don't remember the exact number, but a lot of people, I think it was like a third of people thought we were in a euphoric tape. You have like a bubble in bubble watchers. Everybody is looking for the top. Most people on TV are overly cautious and worried about, this level and that level and this pullback. We're in constant fear of the Fed. If you traded in 1999 like I did, you know what true euphoria is. That is when it's Katie bar the door, everybody is long, your dentist, your, cab driver, everyone is talking. Back in 1999, I used to be afraid to go to my dentist because they would spend more time watching the ticker than taking care of me. In 2007, anytime I got into a cab in New York City, every cab driver seemed to have the scoop on Sirius satellite radio. For the first time in a long time, I had a professional talk to me about stocks, and they told me that the market was going to get cut in half and that gold was going to double. That, to me, is not euphoric. That is a lot of skepticism. I will tell you this. When I trade, and this is just me personally, just because this works for me doesn't mean it's going to work for you. It doesn't mean that I believe it's the right way to trade. I tend to try to keep it really simple. The less moving parts you have in something, like for example, a Glock. It has the least amount of moving parts. It doesn't break as much. It's one of the best handguns in the world or what have you. The same thing with a trading system. The more moving parts you have in it, the more this than that, there are, I guess, instances, room for error. I like to trade along the dominant trend. If a stock is going higher, I buy the dips. If a stock is going lower, and when I say higher, I mean it's making higher lows and higher highs. It's on trend. It's above moving averages. It's above horizontal breakout levels. I am in buy the dip mode, meaning when I'm not looking to pick the top, I'm looking to buy it on pullbacks. Conversely, if a stock is making lower highs and lower lows and breaking horizontal supports, it has overhead supply, I'm looking to short rallies in that stock. Here is the caveat. It's the best when you are in a trending market, meaning if a market is trending higher, it's good to be also to play by the dips, and you would in that instance, or I in that instance would be playing in bigger size. If a market is trending down and I have a downtrending stock, I'll be playing in bigger size. If a market is sideways, I will be playing in smaller size. That is just simple. I was talking about Disney the other day. I had been in put spreads. I actually was short for earnings, which turned out to be a nice little treat. That was another instance when a stock, and I'll get to Restoration Hardware in a minute, why I said to pull the trigger and sell it basically at the high of the day today. Anyone who followed me with that, I'm sure is, drinks are on you. Anyway, let's discuss Disney. The sentiment was really bullish again. It had gone down quite a bit. It did the slow creep back up. and I didn't believe any of the fundamentals had changed that caused it to have the smackdown, and it wound up going lower. In a trending down market, I would have probably been pressing that short and adding and holding. I was starting to notice it hesitating down near lows. I still think the stock has the potential to go lower, but my goose sort of would be cooked if it just stayed sideways. Volatility started to compress in the options. I was basically got out at sort of the max amount that I could get out in it. And yes, I mean, I still think it might go lower, but for my specific trade, it was time to book. Let's talk about. I'm just reading some of the comments. All right, we'll talk about the fins in a minute. All right, so the same thing basically with Restoration Hardware. I got in very well at the near the lows, and the stock I think I saw it was up over $3.60 something from where I had bought it. I wasn't huge size in it, but enough, that it was a decent profit. My theory on that was if it hadn't moved and it basically just hugged the lows, I was going to hold it into earnings. If it rallied, which it did, I was going to book it, and it wound up being the correct move. I started getting messages from people asking if the stock was going back into the 50s. It started to seem to me like it was getting chased, and the people who were buying into it would not be happy when it didn't report well. It's missed basically it's gone down on the last two earnings. I didn't want to be the pioneer hoping this was going to be the silver bullet quarter. I also knew from the back of my head that Home Depot, when it reported, couldn't go higher on good numbers. It's actually been going lower. So that is a sector issue as well. So it's sort of an amalgam for me. It's a bit of a process. I'm not always so conscious of what it is. A lot of it is just experience. It's sort of like driving stick shift. If your first time driving stick shift, you're probably going to grind the gears and stall out a lot. But if you've been driving it for years, it's like almost like a extension of your body, the shift. So for me, I can feel the feedback from the market often and know when it's time to upshift or downshift. And I'll say this, I didn't know Restoration Hardware was going to be down, whatever, it's down 15% or something after hours, but I did know that it was time to go. So we basically sold, I basically sold it at the high, I don't think I got the exact high tick, but it was in that press bar I talked about. Often on earnings days, you'll get, this also was concerning me, I didn't like that it was getting an excess high during regular trading hours. There were just a bunch of things I was seeing that was signaling the alarm to me, and it was time to get out. I did 2 tweets on it. I talked about looking to lighten up, and then again said that this is the press up that we could use to get out. I really hope people took it. Yeah, so that's sort of my logic. It was a little bit of a technical issue. It was a little bit of a market feel, and then hearing when people were asking me if the stock is getting back into the 50s, when the expected move is a third of that, really got the alarm bells going. And I knew it today. I was probably planning on getting out of it. It wound up being great. I got home from my very traumatic experience in the government offices today to come back and catch the high of the day with that. So that was that. I would also just take a look at these stocks. Ones that have had outsized moves down and then have rallied back up. That rally back up winds up leading into a move back down. That's just been my experience in the past. Again, experience and feel. Some of the things I want to talk about come out of the risk management bullet points. I've never gone over these live, but I will go over a few of them here. Some of the things I see traders making mistakes in is that they often have too many positions on. I have made this mistake myself. It has always led to problems. You can't know everything. You can't follow every stock all day, every day. There are pieces of news. It just happens that way. There aren't really that many stocks at any given point of time where you want to be, super duper, you're not running a mutual fund here. That's also one of the reasons why mutual funds historically have such terrible performance, because they have the good ones and they have the bad ones, and in the end, the thing is just there to generate fees. So your money basically is just churning. It's not really a winning strategy. You want to be in You want to be in stocks that are making, like I said, long stocks that are making higher lows and higher highs, and short stocks that are making lower highs and lower lows. I know that sounds really quaint. It sounds very basic, but just I'll tell you, the more you keep it simple, stupid in the market, the better your returns will be. Trying to outthink things and overthink things will wind up in losses. You'll start justifying things to yourself. Like, for example, today, this morning, I bought Pay, Verifone, not a huge amount, but an all right chunk for a tester. And I bought it for, I have to check the fills. It was like just under 20 or right at 20 or whatever. I think the stock was basically trading $20. And I said that the key to that was because it was a reference level. I think 2014, if memory serves me correctly, was the past low. I don't always assume that reference lows are going to break. I assume that they may have a hold. And I was basically doing a trade setup that I've done countless times. If a stock gaps down, you want to take a look at a couple of things. One is if the regular trading hours low of day is higher or lower than the after hours or the pre-market low of day. If it breaks that after hours or pre-market low of day, the stock is likely going significantly lower. If the RTH, regular trading hours, low of day, is higher than the one that it made in the pre-market or after hours, and you can get over the first 5-minute high of the bar, first 5-minute high bar, you'll probably get a bit of a bounce. I put that trade on. It wound up going higher. It wound up coming back lower. It didn't take me out. I basically set my stop today below the pre-market low of 19.5, and I just kind of set it and forget it. I got a notification while I was on my way home, and I thought I was probably stopped out of it, and it turned out that it had broken the high of the day, so I was a little happy with that. Someone asked me, am I holding the position or not? So let's talk about hope and fear. I hear a lot of professionals say there is never a time to be hopeful in the market. That is actually completely incorrect. You should be hopeful when you have profits that your profits will become bigger profits. You should not be hopeful if you have losses and you're hoping to recoup them. You should be fearful that you're going to lose the losses. The psychological way that human beings are made up is that we fear losing a gain and hope to recover a loss. That is what really weighs on you. Have you ever been in a position where you wake up in the morning and basically, your portfolio is not doing well, everything is basically going against you, you're kind of just struggling, you're not in the right stocks, you probably missed the cycle and it's starting to change? My advice to you in that instance is to clear the decks before it gets really bad. If you're having more than like 2 or 3 days of that in a row, it's probably an issue. If things are breaking supports and you find yourself trying to justify why you're in them, it's past your technical stops, just get the F out and start over. You're not only going to lose money on the positions that you're in poorly, you are going to miss opportunities for stocks that you should be in. So it's a double whammy. You get the fact that you're losing money and you're in a bad mindset, or you're in and you're missing out on the opportunity of being in the right positions. I can't tell you how important that 6 inches between your ears here is in terms of being a successful trader, being in the mindset of being in profitable positions and knowing you're right. Most people, and I'll tell you this is in life, I'll bring it down to real life levels. Think about relationships. We've all had that moment where we cross the deal breaker moment, where we know things are kind of effed, but it's hard to get out of it, right? It's hard to pull the trigger to get out of the relationship, even though you know things have changed. You hope things will get better. You hope, it'll change. It only gets worse, right? So it's the same thing in trading. You want to just get out when, the getting's good. It's often hard to take the small loss because you're not really wrong yet, right? The big loss is when things are, gapping down on you 30% or what have you. There's usually, once in a while, listen, everyone gets blindsided once in a while. I've had it happen to me where, I'm in a position and it's I look at the chart. Sometimes I've done some, back analysis, and I realize, oh, I went wrong here. It should have, I should have been out of it. But most of the time, my charts are correct. The levels are correct. I'll get blindsided once in a while because of news. It just happens, and then I'll manage the, I don't get too emotional about it. I get pissed or whatever, but I manage I use my risk management tools with gap rules, and I handle it, But for the most part, most people know there are signs of being wrong before they're really wrong. And that small loss, if you can just say your setup, the reason you were in it, like for example today, that I'm going to use the Verifone example. Let's say it didn't go my way and it went lower and it broke 19.5. I originally got in with the right size. That's also key, being managing your risk on order entry. Do I use stops even if they're not moved? Well, I'll get to that in a second about using stop losses. Yes, I do use a stop loss even if it isn't going against me. But let's just talk about this. I want to just give this example because this is a really primo example. So I put the position on. My size was right in the beginning. I wasn't really worried about it. I was able to go and do what I had to do today. I wasn't even in front of my computer. I set my stop loss below that low pre-market. If I didn't do that, or let's say I was by my computer, I might not have set that stop loss. I might have waited and had an alert. Let's assume it goes off, and I say, you know what, let me give it a few more minutes. Okay, fair enough. The stock keeps going lower. What do? Most people will say, oh, I'm kind of hoping it comes back up. The right answer is just get the F out of it. The setup, your initial setup of stopping out below that low, your trade setup is done. A lot of people, and I'll tell you this, I have friends of mine who fancy themselves traders. They're really not. But they want to be right. Everybody wants to be right. I always want to be right. The difference between me wanting to be right and, let's say, one of my friends who want to be right is that they care about the thesis, the setup. I just want to make money. And for me to be right and to be wrong, there is a subtle step in between that people miss. Let's discuss this. If you can recognize this in yourself, I could almost guarantee you're going to see a huge difference in your returns. So from going from right to wrong, you have to first stop being right, and then you become wrong. To first stop being wrong, to stop being wrong, you have to first stop being wrong to become right. If a setup changes, let's say I'm bullish on something, or I'm bearish on something, the minute I see my thesis change, I'll flip with it. It takes a lot of discipline and a lot of training to do that, but just work on it and practice on it. Being right is being on the right side of the trade, not your reason for getting in longer being right. I'll tell you, I've been in trades where I've been long, and 10 minutes later, it's not feeling right to me, and I'll be short within almost the same keystroke. I'll close the position and then be short, or the same thing. Often some of my biggest long trades I start out short in, it doesn't act properly, I flip, I cover that small little whatever loss, sometimes it's even break even, and then I'm long for the move up. The being right is on the right side of the trade, making money. It doesn't matter what you think, the market is bigger than you. The only right trade is the right side of the trade. The thesis, the reasons why, like think about all these bears and people who have been short, the head and shoulders, this and that. The markets are, have a huge PE multiple, unemployment is terrible, GDP is not doing well, price is truth. The reason is the Fed, the market is going higher. Fight it all you want, you would have lost money. That is just how it is. They could be right, their reasons are right, but they're wrong dollar-wise. That is all that matters. All right, so do we want to talk about the head and shoulders setup? I talked about it in the video. I'm just curious if you guys could give like a yes, no. If you want, I'll talk about it. No, we don't want to talk about it? No. Okay, we won't need to cover it. Okay, cool. We're done. I love this. I don't have to waste any time. Do we want to talk about the Fed and Yellen and all, or no? Have we covered that ad infinitum? Yeah, the head and shoulders was important. Yeah, so we want to talk. No? Yes? Oh, it's a little mixed. So let's do a little Fed talk. I think I covered a lot of that psychological stuff. There is a few more pieces. Let's get through a little bit more. I wish I knew what I did. I just had this up on my screen. I think I closed it, which sucks because it'll take time to reopen, which we don't really have time to do. Oh, no, it's right here, so we could do it. All right, so I talked about the being price is truth. I talk about the trend being your friend. Planning your trades, like I talked about with the entry and exit, knowing some of that, where you're gonna, say you're wrong in the trade initially. I find coming into a trade from a cool, calm, collected place when you're not in the middle of, things going haywire or things going really well, plan that stuff ahead of time. Don't just take something, often you can just take something on the fly, but have the discipline to know when you're wrong and just honor that stop. It'll save a lot of money. Here was another one I talked about. I want to just emphasize that one more time. Having your size right at order entry. Right or right out trades. I often go very large on right or right out trades just because it's right or right out. If I'm a little less certain about it, I'll go smaller. Let's talk about another issue that I get messaged about all the time. Like I said, you can't trade. You could win I think the Livermore saying is you could win a bet on a horse race, but you can't beat horse racing. I have people message me all the time. I'm involved or looking to get involved in a stock. I can't make heads or tails of the chart, and I'll take a look at it also. And I'm like let's say Alibaba, for example. It's a very mixed up chart. It has a lot of false dawns and a lot of false breakdowns. That's harder money, right? Why not just pick something that's in a nice uptrend or that has a clear horizontal resistance that you're playing the breakout or the check back? When you have a messy chart or something that's not clear, you're guessing. That is not where you want to be. I've often found myself trying to be smarter than I am, trying to guess in a chart that really is a mishmash. Experience has told me, forget it. It's not playable. Yes, you could guess right. You could flip a coin and be long, or flip a coin and be short and be right. You can also be wrong. I only like to take trades where I feel I may not have an edge, but I at least believe I have an edge. Meaning there is something in the chart, there's something technically I'm seeing that I can base a thesis off of. If it's a messy chart and it's had a lot of this chop, why waste your time? Why be the hero? It's not going to pay you. It's not going to, do anything for you. If anything, it's just going to cause agita and put more, doubt into your equation. Now, this is another one. I often see people. I don't want to mention any names, but they talk about scaling into positions. Yes, I like scaling into positions, but only when I'm right. If I buy a stock and it goes down, I'm not going to add to it. It's just not how I'm built. I'll only add to it once my first buy is correct. Why? Because have you ever heard the expression, don't put good money after bad money? If you're wrong, if you started wrong, think about building a building. Would you start building if the foundation was still wet or not solid or didn't pass inspection? What's going to happen when you get up to a high floor? The whole building is going to fall over because the foundation is weak. You need a strong, solid foundation to build a position off of. And if you start off wrong and you start off weak, you're going to get your, what's the huff and all puff until they blow your house in? That's the problem. You need a solid foundation before you build positions. So yes, scaling, but on the way up, not on the way down. You just start adding to losses. Look what happened to Bill Ackman, for example, with Valiant. He was long. He added a lot at 108. The stock's barely can't even hold 25 right now. I mean, imagine that. I mean, that's an incredible beatdown. I mean, if something's going against me, I'm immediately in risk management mode. I'm not looking to add to the problems. It's just that's just, I don't know. It's just not the way I was brought up. It's not how I've been taught to trade. Based on my experience, it has taught me to play it the other way. Be right before you add. Um, let's see. Take profits along the way. Someone was asking me about stops. If I'm right in a trade, yes. If a stock's in an uptrend and I'm right, the minute it breaks the trend, like what happened in Apple a couple of days ago, I was out, and then there was a gap, like that Friday, remember, and then Monday was a gap and go lower. I wrote it. Once I saw the trend snap, I was out. That was my stop. There are other instances like that too. If you get into a gap fill or you get into a trend resistance, I'll often take profits. I could always add it back, a little low. Even if I have to buy it back higher, it's fine. But usually I wind up adding back in the instances on a pullback, like a retest of trend. Like if the play was to move to the 50, it'll pull back, it'll hit trend, and then you can load it up again for a right or right out trade. Very simple, very, very simple. Oh, this is a big time. I'm just curious. I don't want to ask anyone to say if they've had this happen to them, but I know it has because I've gotten some messages from people. You see your account, like particularly people with smaller accounts, they're always looking to double it or make big gains. So often they are at max margin all the time. They're always fully invested. This works very well until it doesn't, and when it doesn't, it really doesn't. You'll make a lot of money for a while. You'll have outperformance in terms of your returns. I'm going to talk about beta weighting actually right here for a moment. But when things go against you, we all know markets are asymmetric, and when that momentum shifts against you, it will bury you. I forget the exact statistic, but I believe if you're a third of the time, you can risk blowing yourself up if you're always at max. Beta weighting. This is something I'll tell you where this has helped me. Remember when I said if your portfolio is doing badly day after day just to get out of it? How to know when things are bottoming and when things are about to top. This is a very useful trick. If you beta weight your portfolio, I tend to trade in NASDAQ stocks, so I beta weight it to the Qs. I look at where my portfolio is or my positions are in relation to the market. If I am massively outperforming the market for multiple days, I'm probably getting near a top with my positions, and I'll start to look to take it off. Most people, more rookie traders, will get very excited by this and add to positions or not have risk management discipline. I assure you, you will be very, very sorry if that is the case. Conversely, if I start to notice that the market is down more than my positions, I realize that I am positioned correctly and then might add to them because I'm outperforming the market in terms of being on the downside. So you want to be wary when you're massively outperforming the market when it's moving up modestly. Like let's say you have I don't know, I'm just going to pull a random number, a $500 delta. And that would mean for every point the Q moves up or down, you should theoretically make or lose $500. Let's say the Qs are up $1, but you're up like $3,000. You're massively outperforming. If you have usually one day of that is okay, but when it's like 3 to 5 days, that's when you want to start to get out because things are looking like they're going to turn. Same thing with the downside, just flip it to the other way. That's a little trick I don't think a lot of people know, but I assure you it's a gem. I wish someone had told me that when I was younger. I have rules with particular stocks, and then I have the rules to kind of keep the lights on in the in the business. You never really want to let your account ever get a bigger drawdown than 10 to 15% max. I, believe it or not, won't often even let it get that far, but that's sort of within the range where you only have to make that same amount back to break even. If you start having big drawdowns, like 25%, it takes 33% to get back, 30% takes 43%, it starts getting harder and harder. So just, if it becomes more than 10 or 15%, you might want to look to do the old flatten up. Don't be too emotional. I talked about, if your heart's racing and you're worried every morning, if you wake up and you think you're going to be down every day, your position's too big, or you're just not positioned correctly, you probably missed the cycle, and you want to just kind of clear out of there. And then I always just say take profits along the way. Just if you have a big gain in something and it's reached some targets, don't be afraid to take a little off. That's really the right way to do it. So I think I covered a lot of the psychological stuff I wanted to talk about. I'll do a little bit of stock-specific stuff here. I'm hoping to, one, keep the broadcast not too long, and then two, to not get too technical. So, wow, Restoration Hardware is getting absolutely obliterated. We sold that thing mid-36s. It can't even hold 30 right now. Holy cow. All those people who were chasing it today and paying us 36s for it will probably be happy to sell it back to us a lot lower tomorrow or the next day. I would be really careful here with it if it takes out and holds below the 3083 reference low, 3083 to 3032. That's a really important number. And I think that this is probably going to get a pretty sizable washout because this is a big disappointment after a few disappointments. So we'll monitor that situation quite actively in the next few days. I am looking to get back into that when it starts trading below 10 times earnings, like 8 or 9 times earnings. I think it was back up to over 15 or 16, which isn't too terrible, but it was a market multiple for a stock that was disappointing. Facebook. I don't really know how to tell you that the stock is in one of those consolidation patterns. It tends to do this choppy back and forth move. It usually tends to resolve lower and winds up being a buy at a gap fill or a 200 MA. I do think the stock is going to see 130 longer term. The 50 MA has caught up quite a bit to 115.56. If you want to be long, or if you're long, just stay long against the 50 MA. Anything below there gets iffy. It's not quite the 116s, but the 116s is really where you want it to hold. Below there, iffy. Above there, the hope of new highs still remains. Goldman Sachs, I got a lot of questions about this today. It was a head and shoulders breakdown. It had a bit of a check back. It didn't quite fully get back up to the neckline, but it got up to like maybe high enough. I think that this stock could maybe grind lower. I think it's going to be a very frustrating short, though. I've seen this pattern before. It's gonna go, but it's gonna go in drips and drabs, and there'll be moves back up. It'll be a pain in the you know what. If you want to do it, if you want to do some shorts on that, just keep it a stop. Let's say it's below the 50 MA here. You could use a 50 MA stop. We could even do a little better than that. We have 4 days of consolidation. Just watch the low there, the 153.86-ish area. There was more consolidation there. If you want to try a row short, fine below there, but I would just keep trailing down the stop and maybe use smaller size because the market is doing well, and we don't have the down market with the down stock. You usually want to do a little smaller size in that instance. Someone asked me about the gap. All right, so I actually am long a little gap. I added to the long a little bit as a tester here. So why did I play the gap here? All right, so this stock has been down a lot. It's really, I think, way past its prime and heyday. I do think in the back of my head for some reason that private equity is going to come in at some point with this, and you're going to wake up one day to a buyout. I just for some I don't know anything. I just have that feeling. So here's the scoop. It's making higher lows and higher highs. It went up. The gap for the earnings was up on 6% comp store sales going lower. So the news was bad, but the stock went up. I love when that happens. I also like that it was basically it was a mini professional gap. Anything on this stock over 1943 is still a long, and I wouldn't really start questioning that until you really kind of, took out the gap day low. I mean, this could chop around. This is first looking into the gap a little, the other gap. You have 1966-ish area. We could do a little bit of a chop here, but it seems to me like it might want to fill. If we start getting below the breakout bar day, 1906 or whatever, I'll probably reduce the size back just to the original position size, and then if we get back below 1870, I would just flatten it up. Really, really simple. Gap has a decent dividend. It's really not that expensive. Remember when I talked about stocks that are below 10 times earnings? This is trading like 9 times earnings with a 4.71% dividend. I don't know if they're going to be able to keep that dividend or whatever, but I do think that it is it's cheap. I mean, it's not a very expensive stock. It's just I'm just playing for a bit of a bounce, and I have some defined levels. Apple, someone asked about. What do I think about Apple here? All right, so I think Apple will eventually fill the gap to the 103s. For me, 100.72 was an important level. The top of the move was 100.73, so it wound up being the high. It pulled back quite dramatically. It held the 96.69, which is an important level for me. I was really looking for this to get to 95.10 to 93.77, truth be told. It's interesting that it's kind of rallying back up a little bit. So if you can clear the 172, you'll probably see the 103. The premium in this, the IV percentile, is really, really low. So there's no, if you want to sell premium in this, I'm going to give you the William Wallace advice: hold, 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 meaning wait. The IV percentile is 4%. Apple, I'll tell you just from my experience, 25 is about average. The June expiration is 18. Into earnings, I almost can guarantee that this is going to get a IV bump. It always does. The options always get played a lot. If you're short puts, you're going to probably not be so thrilled. I would wait until that IV, then the bump, and then you can play a little bit of that. If this thing continues to rally into the print, I might be playing it short for earnings. If it dumps into the number and there's a little fear, I might be playing it long. In between, we have Worldwide Developer Conference, I think June 13th through 17th. So there might be a little bit of a bid going into that. Just keep that in mind. Someone asked me about MasterCard. It's not a stock I follow very often. It looks like it ran up. It has a bit of a lower high. It looks actually like it's a cup and handle situation here. It held the 50-day very well. I guess it looks okay. I mean, if you want to be, today held the 10. Yeah, wow, this is looking a little bit better. Marabuzu candle today. That's pretty good. All right, you don't want to see it give back more of half of today's bar on a closing basis. If it starts closing below half of today's bar, just GTFO. If it loses the low of today's bar, it's a right or right out short. That's my my feeling on it. So someone forgot to tell Netflix that it was a rally today. The stock is looking kind of weak. It's stalled out at one of my levels, 103.88. The high of the move was 104. That 103.88 to 105 we know has been resistance and support and what have you. Longer term, I probably think Netflix will go higher. Seasonally, this is not a good quarter for Netflix. I've actually, believe it or not, had some of my biggest shorts ever in Netflix, and it's always been in the summer. It's right on the 50 MA. If you want to play row against the 50 MA, that's it. So it's right or right out, or we maybe look back to the 92s as a right or right out level. I wouldn't mind playing put ratios, actually, buying a put and selling 2 times out of the money at or below those 92 strikes. Near dated, I wouldn't go past next week. Twitter is, I was going to use some foul language to describe some things there. All right, so I'm actually long Twitter. I like the idea that there was a downgrade and it had a look below and fail. As long as the stock is above that look below and fail day, 1422, I think you can play it long. If you want to use the 20 MA, that was when we had the gap and go below there. So it broke the 20 MA. It should theoretically hold the 20 MA here. So I like it long over the 20 MA and maybe not as long below the 20 MA. I will just tell you this, great property. I love Twitter. It's actually I think my favorite social media, although Instagram is starting to eclipse it. I really think Snapchat is picking up a lot of share there with the youth. I don't really see Snapchat and Instagram being so much of competition, but I'm sorry, Snapchat and Instagram are absolutely competition, but I mean Snapchat and Twitter being so much competition, but I don't like that Twitter. You know, the other day they talked about that they're going to stop putting names and hyperlinks as character counts. Why didn't they just launch it the same day? Like, what is taking so long with these updates? These are like no-brainer updates that they should be doing, and they're just moving too effing slow. That's it. I mean, someone should go over there and just give them a good swift kick in the ass and get it going. At some point, this would probably be a buyout, but the problem is that will be a lot lower than you'll want to be long the stock. They're going to probably have to get it together and show some growth. If I were Google or whatever, I'd either be looking to buy this thing in single digits or wait to see the turn in MAUs, that like things are getting better. We're getting light from outside that is interfering with my head here. All right, that's a little better there. That was Twitter. Tesla. All right, so I want to just keep it really simple, stupid in Tesla. So they had a secondary. It was priced at $215. As long as the stock is above $215, I like it long, rather be long than short. This, by the way, seasonally is good for Tesla. It always usually peaks at the end of the summer. I often talk about the Campton Classic, the horse show. Yeah, I mean, this leg, it only got the 50% fib. I was really hoping for a bit of a move down to the 191s, but it held basically the 205s. Today closed a little bit with a topping tail. You have a 50 MA. If you want to try a right or right out short, you could do it below the low of day today. With a stop, I wouldn't really start letting it get back above 233.44. If you have this could be a secure high play here. If you have a lower high tomorrow, like if it's down weak and then kind of closes below the body. But I'd rather honestly be more of a BTD in Tesla than shorting it here. I do think that this stock, and I know this is a little controversial, but it probably will see the highs again. I'd actually be a little surprised if it didn't. That being said, 265 has been a very big level. If you get up there again, this would be now from a higher low and closer. If you can really clear and hold 265, this stock is going to really run. That is the momentum threshold level. I actually don't really think you need to futz around with it here. You could wait for that move. The best thing for this would be to get up to the 265, spend a little time just consolidating there, and then it could probably really take off. So let's watch that level. If you're already in the position, 215 above long. If you're kind of playing the wait and see, let's see what happens back up at that 265. Someone asked me about JetBlue. All right, I had been bullish on this a while back and kind of got out actually quite presciently. I didn't quite get the high, but I got pretty good. I think I got out at close to the 25s or the 24s. I was pissed it went to the 27s, but it's back lower, which is okay. We have a primary trend coming into line with the flash crash low, which I will be interested in. The 61.8 is also down around the 15, so I would probably be looking to sell 15 or 14 puts for a right or right out trade with that if we do go a little bit lower. We did have a bit of a... Did the trend break here? Let's see. I don't think the trend... Did we break? No, the trend didn't break yet. So you can... And the trend coincides right with the 50 MA. So you either need a break and a hold of the 50-day moving average, or I'd be interested in a little bit lower. Let's just keep that really simple. You need a break of the 50 MA and the downtrend with a confirmation day the following, and then you'd want to buy it down closer to trend and the 61.8. All right, I think I'm going to wrap there. One thing I wanted to talk about just briefly was the poll I ran. I'm running a poll about bullish or bearish. 43% bullish, 28% bearish, and 29% neutral. Usually I don't start getting too worried about the bullish scenario until it starts peaking 50%. So there's likely a little bit more runway in sentiment. And as far as SPY goes, which I amazingly neglected to discuss here, but we'll get to it right now. If you're really, really short-term money, 212.24 is a key level. You likely won't be able to find why it's important on the chart, but you can just take my word it is. Above there really is good. I wouldn't really start getting too bearish until we take out like 208.97 again. You know, it wouldn't surprise me to see some type of a liquidation break, a little short-term scare back down into that area. That's sort of what happened with the 204 level. Remember, we kind of got back up and then had a sharp move down and then relaunched. We're near the channel high. I think that the likely scenario here is that we do get either some type of a liquidation break, or it's a grind higher and we ride the channel line up. That is a little precarious on how to play that. It would mean, yes, that we will likely get the old all-time high and probably make a higher high, but that also increases exponentially, in my experience, the probability of a very large liquidation break after that happens. So I still think the market, I'm still in the all-time high camp. The fact that we broke the head and shoulders pattern and we are now above the head, that is very, very bullish. When you have pattern failure, and everyone who bet with that pattern is wrong, it's very powerful, particularly a head and shoulders failure to the upside. Often, like I talk about, picture tweezer lows or double bottom lows. That's when you have two candles, my finger, or let's use this, where they're basically equal lows, and then you have the rally, and then those lows are violated. The move is often very violent lower. The same thing with a move to the upside. If you have double tops, comes down and then that's taken, it's a very violent move to the upside. Always think about who is right and who is wrong and who is particularly happy and who's in pain. If people have when there's pattern failure, you want to play with the direction of the break. So if you have a double top and it breaks, you want to play to the upside. If you have a double bottom and it breaks, you want to play to the downside. That's my view. I think we're probably going to see the all-time high at this point. We have done some very significant things in the market. We had a pretty big consolidation with that whole head and shoulders scare. We're now making higher highs than the last swing highs, which is always a good sign. And we're just like a stone's throw away. It just seems to me like that we're gonna go. If you're bearish, you know, you just there is a couple of things I'm starting to notice that has me a little bit cautious. It's interesting that the VIX has been flat or slightly up on up days now. I think that the volatility is kind of kissing the range lows, and that's why I think we might get a little bit of one of these scare days. I don't know that, you know, it'll freak everyone out, all the chasers. I don't want to mention any names, but if you follow some of the subscription guys who I don't want to say anything, but a lot of them are really just chasers. Some of them really couldn't trade their way out of a paper bag, in my view. But they'll get all panicky. It'll probably last a day or two, and then, you know, it'll probably be a move back. We've had a lot of intraday liquidation breaks. I often talk about the poor highs, meaning you have late to the party longs, there's a liquidation, and then it comes back up. Those liquidation breaks actually strengthen the tape. So we've had a lot of them, and we don't have excess on the market, and we've been putting in like all these poor highs. So it seems to me like we may have a move higher. Today we repaired yesterday's poor high, had the liquidation break, and then made new poor highs. So there tends to be a liquidation break and then a repair. That's usually the pattern. So if you know the game the market is playing, then you know what to do. Anyhow, that's my story. I'm sticking to it. If you want to see this broadcast, it will be back up on my YouTube channel. I don't know, probably a few minutes. I'm going to upload it right now. Anyhow, thanks for watching. I hope you guys found this video helpful. If you're not following me on Twitter, my handle is @JustinPulitzer, and my YouTube channel is Justin Pulitzer Trades. I will be doing the Sunday video. Here's a little scoop with the Sunday video. I post it. I shoot it in a very high resolution. It's actually shot in 5K. Maybe that's why it takes so long to upload. But if you wait a little while and reload, the resolution is quite spectacular. All right, that's my story. I'm sticking to it, and cheers.